Hey, good morning. This is Jerry here over at Wealth Dynamics, coming to you with a real quick video. I'm on my way to the headquarters right now, and I just wanted to give you guys an update on non-correlating assets. So I've been talking the last couple of days about how to invest during a recession. How to invest during a recession. Now, a recession is on the way. All the indicators are showing that, and we're preparing for it. I hope you are too. If you're not, I want to make you aware that there are three types of asset classes that you can invest in. Okay, so there's what's called a correlating asset, which means it's going to go with the market. If the market goes up, it goes up. If the market goes down, it goes down. So in a recession, when the market goes down, you can imagine what a correlating asset is going to do. There's also what's called an inversely correlating asset. And then lastly, there are non-correlating assets. And that's the topic of today's video. So a non-correlating asset, non-correlating. Non obviously means that it doesn't do something, right? It's not there. Correlating refers to the trend that it follows as an investment with its ups and downs. So if it's correlating, again, it goes with the market. If it's non-correlating, that means that it does not go with the market. I want you to think about that. So non-correlating. So if the market goes up, it means that your investment doesn't go up as a byproduct. And if the market goes down, it also means your investment doesn't go down as a byproduct. That's non-correlating. So the benefit of non-correlating assets is these investments don't depend on the market. If you're investing for passive income, if you're investing for, let's say appreciation even, and you've got non-correlating assets, it means that you're going to have consistent growth throughout the period you hold that investment, and it's dictated by that investment, not by the market and not by outside indicators. So that's really nice. And I'm going to give you a couple examples. So an example of one of my favorite non-correlating assets, small business equity. Okay, now this depends on the type of company you're in. Obviously, if it's a small business that's in oil or real estate, maybe that's not going to be a non-correlating asset. But for example, a business like mine, financial services, doesn't matter whether there's a recession or not a recession, people need help with finances. In a recession, people probably need even more help with finances. So that's a good example of a non-correlating asset. We don't have ups and downs based on recessions. So if you're investing in a business, a small business, let's say you're doing private equity, or you own the business, or you're a limited partner or a general partner, or you're an investor, you want to look at companies that don't really trend with the market. They're not going to do better because it's in a boom, and they're not going to do worse because it's in a bust. So that's the thing with non-correlating assets. That small business is still going to produce revenue, and it's still going to produce profit, whether the market was up or whether the market was down. And it's the difference between microeconomics and macroeconomics. So macroeconomics means that the S&P 500 is down, and therefore the company doesn't perform as well. Microeconomics is based on local factors. Okay, so if it's local factors and the factors that are local aren't related to the market, there's a good chance you can invest in that business and not have it affected by a recession. Now, the other one that's non-correlating that I want to share with you guys, this is another one of my favorites. It's called a life settlement investment. Life settlement investment. Simplified, I'm going to go and explain this to you because it's not something that most people are aware of. A life settlement investment is when you as an investor buy an existing life insurance policy from somebody who currently owns it. Okay, a lot of times this is going to be senior citizens. A lot of times this is going to be people that either have medical expenses coming up or retirement expenses coming up, or they just want the liquidity. Okay, and so what we do with a life settlement investment is, let's say, there's somebody that owns a policy, they're 80 years old, and let's say they have $100,000 in cash value of that policy. Now, they don't want the $100,000 in cash value. They just want to get rid of the policy because it's got $1 million death benefit. They're paying premiums on it. They don't want to keep paying the premiums. They're not going to see the death benefit anyways because it's going to go to beneficiaries, not them. So they will sell that policy on the open market. Now, a lot of times a policy can be sold for about 3 times the cash value. So think about it. If I'm 80 and I've got cash value of 100 grand, and I know that I can sell it for 300 grand to an investor, I'm probably going to do that because I want 300,000, not 100,000. Okay. The other benefit is the investor takes over the premium. So if you're the investor, you're going to take over the premium payment. You're going to cash up on 300,000, and then you become named as the beneficiary on that policy, meaning when the insured dies, the death benefit goes to you. So that's non-correlating, because if you think about it, their death benefit is not based on the market, it's not based on real estate, it's based on their lifespan. And a lot of times on the life settlement market, these policies are very heavily underwritten by a third party. The selling party is as involved in it as the buying party is. They're trying to get rid of a policy. They don't want it anymore. So they're trying to sell it. They're going to go through the underwriting to prove this is my lifespan. So they'll show, hey, I've got a lifespan of 10 years based on what all this third party underwriting is saying, which means in 10 years, there's a high chance that I'm going to pass away and you're going to get $1 million death benefit. So if you do the math on that, you put $300,000 in and it turns into $1 million over 10 years, you more than tripled your money over a 10-year period, and it had nothing to do with the market. You probably went through recessions, you probably went through booms, and you probably went through busts, but you still made money. Now here's the other great thing on a life settlement, is that it's going to pay no matter what. Okay, the person is going to pass away no matter what. It's just a matter of time, and so you know that there's no chance you're going to lose money on it. You're going to get the death benefit, it's going to happen. So that's great. And the other thing that's cool too, I have several clients that invest in these. It really is kind of a social type of investing. Lots of times the seniors that are selling these, they're in a hard spot and they need the money. And they're very happy that you've helped them out and you've cashed them out of their policy and they're getting 300 grand instead of 100 grand. I like helping people, so that part's great. I love the fact that you're able to help somebody and it's not just profit margin and nobody's really getting a benefit. You're really giving somebody a lot of value too. But I wanted to share that. So those are two examples, small business equity and life settlements. Those are non-correlating assets. If you have money that you have in a 401k, an IRA, a bank account, a mutual fund, those are all assets that you can move into small business equity and life settlements instead of leaving them in the market. And I'm going to say this again before I sign out here. If you lost money in the last recession and you're doing the same type of stuff you did before the last recession, putting your money in the market, trying to put money in your home, you're going to lose money again this time. It didn't work last time. It's not going to start working for you all of a sudden. So guys, really quick, by the way, I did make a free membership site called jerryfetta.com/recession. I just dropped the link for that in the comments. So if you're watching this today and you want to learn more about things like small business equity, private equity investing, life settlement investing, non-correlating assets, if you click the link in the comments, that is a free course. It's a free membership site. You can set up your profile. It costs you nothing. You do not need to put in a credit card number. Just put in your profile information, create your login, and you get instant access. So if you click on that link, you'll get free access. There's about 3 hours of content in there. So there's 3 modules. Module number 1 is an hour-long video course. Okay, it's an hour long. It's going to take you through all of the different asset classes that are out there and which ones you want to be in and which ones you want to avoid when a recession does hit. Okay, the second module is an ebook. So if you check out the ebook, that's going to be fully detailed. I wrote it myself, and it's going to give you the down and dirty, if you will, on where to put your funds during a recession. You'll really be able to dive deep and master that content. It's in a flip book version. I think you can highlight and underline as well if you've got a Kindle. And then lastly, there is an article too. So if you want the summary, module 3 is an article. So it's going to give you a clarifying summary of the content you just went through to help make sure that you get the high points, the bullet points on what you need to retain, know, and follow. And so that's going to be module 3. So if you click on that link, if you would like access to that free course, click on that link. Again, jerryfetta.com/recession. Thank you for watching. Make sure that you do like, share, and subscribe, and I will talk to you soon.